What's going on, my lovers? Welcome back. How would you like to have an entirely passive stream of income hit your bank account every month? Does getting paid money to do absolutely nothing sound like something you'd be interested in? It should interest you. Today I'm going to outline 3 ways that you can build yourself a nice, consistent, reliable stream of passive income through dividends. So option 1, as you can see here, it follows the traditional route of dividends, investing in individual dividend paying companies. I've listed out some quality companies here, the likes of which J&J, Clorox. These companies have been around forever and been paying dividends and increasing them consistently for in some cases over 50 years. So some of the pros of doing this option 1, going the traditional route with individual stock, you have more potential for growth and capital appreciation, meaning you will probably make money as these stock prices go up alongside with the dividends that they'll be paying out monthly or quarterly. Now for cons, in general, they do have relatively lower yields. Some of them are more in the medium range. Some of them are high, like Altria. But you have to find quality companies. It's important to not fall for a dividend yield trap. Usually when you see companies that are paying, absurdly high dividends, 8%, 10%, 12%, it's usually not sustainable, at least not when you're looking at individual companies, or it's very risky and they could stop paying it at any time. Whereas when you invest in quality companies that are paying, say, 3 or 4%, as long as everything is healthy with the business and they continue to do well, they're going to keep paying that dividend quarter after quarter. So let's look at how much some of these companies pay in dividends, and definitely stick around till the end of the video because option 3 is going to pay you a very, very high dividend yield. If you enjoyed the video, please don't forget to like, subscribe, and drop me a comment below if you have any questions. So let's run through the numbers with some of these companies, starting with Johnson & Johnson. Arguably one of the best dividend companies of all time. Currently trades around the $160 range. It has a dividend of $4.24 and a yield of 2.61%, meaning for every share of Johnson & Johnson you hold, you will get $4.24 in dividends annually. Now, Johnson & Johnson has been around over a century, and they've consecutively increased their dividend for 59 straight years, which is just an incredible feat. Their forward payout ratio is 40%, meaning that of all the money they bring in, they only pay out 40% of it in the form of dividends. So in theory, they would have enough room to increase it up to another 60%. But what you can expect is some slow and gradual increases year after year. And that's when it really, really starts to add up, because when you get in at a low price, you increase your yield on cost. Next up, we'll look at AbbVie, and this is all through Dividend.com, a great source to research your dividend stocks. Also has a payout ratio of around 40%, stock price $116. Dividend yield is a little bit higher, $5.64, and a yield of almost 5%. And they've increased their dividend for 49 consecutive years. Now, these are companies that pay their dividends quarterly, but the way you can use it to still get monthly income is if you find 2 other companies that pay dividends on different months, then you have steady income coming in every month of the year. So for example, their last dividend payment was November 15, and they pay the next one February 15. So the next one after that should be in May, and then the 4th dividend payment will come in August. So some other great companies here, obviously Clorox and Procter & Gamble, pay pretty good dividend yields. Now, Apple and Microsoft pay lower dividend yields, but you can expect some more growth with those, and they haven't been paying dividends for as long, so they will probably grow their dividends pretty significantly. So they have a lot of room for growth with their dividends. For example, Apple's dividend yield is only 0.58% or 88 cents per share, which doesn't sound like much, but they're going to steadily increase it, and they're only paying out their payout ratio is only 15%, so they have tons of room for growth. They're going to continue growing this dividend for decades to come. So if you get in now, you could lock in much higher dividend yields down the line. Now, Altria, since stock, has a very high dividend yield of 8%, and it's one of the outliers of high dividend paying stocks that is pretty sustainable. So they pay out $3.60 per share price of $44. Now their forward payout ratio is 74%, so a little bit on the higher end, but they do still have plenty of room to grow it and continue paying it. They've increased it for 13 straight years, and there's also a quarterly dividend. I gave you guys this list here. So if you kind of combine some of these, your J&Js and your AbbVies, your Clorox or Procter & Gamble, those are, I would say, medium yielding dividend stock. Apple is low yield, but maybe you get some more growth. And then you could throw in something like Altria, which it'll all balance out and get you a decent yield, maybe somewhere around 4%. 3M and Starbucks are also great dividend paying stocks. And then the last couple here I want to touch on, I've made videos on Realty Income and Stag in the past. Definitely check those out on the channel if you're interested. You can just type in Realty Income Investment Club or Stag Investment Club on YouTube and they should come up in the results. And also check out my video on J&J. I just made one a few days ago about how the company is splitting up into two separate companies. But if we look at a company like Realty Income, and the same goes for Stag, these are REITs and they actually pay out their dividend monthly. So this dividend, as you can see, November 15, December 15, the 15th of every month, they pay out their dividend, which comes out to about 23 cents a share, annual yield of almost 4% or $2.83. I love my REITs. I love them for consistent, steady cash flow. Realty Income has increased their dividend for 27 straight years. You can ignore the payout ratio here because with REITs, it's all works a little bit differently. So they have plenty of money to cover the dividend. Don't worry about that. And this is another great way that it's even better. Realty Income, every month you get a check from them. Same goes for Stag Industrial. So definitely check out these companies, find ones you're interested in. Comment your favorite dividend companies down below. Let me know what you guys like to invest in. Now, moving on, option 2 here, you could go the dividend ETF route. So if you don't want to pick your own individual stocks, you can invest in an ETF or a basket of dividend paying stocks. A great one in specific is SCHD, the Schwab Dividend Equity ETF, which we'll look at the details in a minute. And the pros of this are that it's an even more passive approach because you don't have to manage, you don't have to keep tabs on how these companies are doing, and you get pretty good growth and capital appreciation. Cons, I would say that the dividend is on the low to medium end. So as we can see here with SCHD, its dividend yield is just under 3%, comes out to $2.35 a share. Currently trades at $79 a share. And as you can see, its total return year to date, you'd be up 23.5%, or in 1 year, 44%. And its 5-year average return is about 17%. It has underperformed the total stock market, but still getting you, arguably the best of both worlds with decent capital appreciation as well as those consistent dividends. So I would say this is great if you want an even more passive approach. You don't want to pick individual companies. Go with a dividend ETF like SCHD. There are many others too to choose from. Now, option 3 here, covered call ETFs. And this option may excite you the most. We're going to go over the pros and cons, but these pay very high dividend yields. Pros, high dividend yield, but the con is that you're going to get little to no capital appreciation or growth in the stock price. So QYLD, XYLD, and RYLD are 3 great covered call ETFs. If we look at QYLD, so as you can see here with QYLD, the stock price doesn't move that much. It's only up 2% in the past year, but it's currently paying out a 10.29% dividend yield, equivalent to $2.36, and it trades at a little under $23. So these covered call ETFs by far have the highest dividend yield, but you're sacrificing the growth. So they're paying a high yield. Say you're getting 10% a year, but you're not going to get much capital appreciation. That could be the advantage. Let's say Johnson & Johnson has a really good year. They pay that 3 or 4% dividend, and the stock price also goes up, let's say 10%, then it will be outperforming this QYLD. But if you're just focused on cash flow, there's no better place than these covered call ETFs to park your money. If you don't care about growth, you'll get a ton of cash flow. And if we look at some examples here, let's say QYLD pays a 10% yield. So if you invested $10,000, QYLD would get you $1,000 in yield annually. So if we divide that by 12 months a year, you're looking at just under $100 a month in cash flow for doing absolutely nothing, sitting on your butt. That's enough money to pay for some cell phone bills, internet, whatever you want. Go out to a nice dinner every month or reinvest it to get that snowball effect, get your dividend income even higher. And then when we compare that to the other two, so SCHD paid a 3% yield. So you're talking $300 a year, significantly less, comes out to about $25 a month, but it's still $25 more than you had originally, and that could pay for a bill. And remember, with that one, you're getting capital appreciation as well. And then with the individual stock route, depending on what you go with, you could go with higher yielders like Altria, things of that nature. Let's just say maybe you could get a 5% average yield out of that one. Would be $500 a year if you invest $10,000, or about $40 a month. And this can only grow if you reinvest it every month. All of a sudden, you start getting these numbers up, and your money starts compounding, and before you know it, you're getting $100 a month in passive income. Then you're getting $500, then $1,000. And before you know it, you're set for life. So these are 3 potential options. Let me know what you think in the comments below. What are your favorite dividend stocks? What do you like to invest in and why? If you enjoyed the video, please don't forget to like, subscribe, and drop me a comment below. This is Vinny from the Investment Club, and I'll see you next time.